Guys, we're going to get going with section two. As you do see, Mark just typed in there himself. Of course, this is going to be replayed at 6 p.m. Eastern Time. Highly encourage you to be able to make it to this evening's presentation as well. This information is a lot to absorb, and definitely it helps to have two reviews of it. So, risk management part two is going to start on page 386. This section will last about 45 minutes. We'll take a little bit longer break after this one, call it 10 minutes, before we get on to risk management part three. And finally, the last section for today will be the post trade analysis and wrap up with Mark. But again, we will be having this entire presentation offered again at 6 p.m. Eastern Time. We'll open the room at 5:30. Yep, try to stay up if you can. It's the best day of the event as far as I'm concerned. With that said, let's get started with risk management part two, page 386 of your workbook.
Okay, so we're back. 2020 Master Trader Program, Super Performance Workshop, online, of course, with David Ryan. David Ryan is taking some time off while I go over risk management. We were talking about risk management when we last left off, and we're going to go back uh, into risk management. You should be on page 386. Taking a look here, we're going to talk about stop loss placement and the various types of stops that you can use and what you'll base them on. Um, the first is what I call just a technical stop, and that's based on the chart. So, for instance, you buy a stock. Look at stock A here. Let me get my little pointer. Stock A here. You buy the stock breaking out. This is a VCP pattern we talked about. It's breaking out. You set your stop maybe below a previous low in the pivot, or if it's shallow enough in the base. In this particular instance, it's a 6% from the buy point. So that's based on the stock price coming down and taking out some type of technical level that you would deem the trade has soured and it's technically damaged. Now, the other type of stop is what I refer to as a mathematical stop. So, not all charts are going to give you a clear technical out. Although what you try to do is back into charts that have those tight entries, so you're getting a combination of a good mathematical stop that makes mathematical sense based on your own reward, your expectancy, and also that it coincides with the chart souring at the same time. But you don't always get that. Sometimes you might have a more volatile situation, like we have here in example B, in this hypothetical chart, where maybe for it to look like the chart really soured, clear cut. In this example, it would be 14% down to the low of the pivot, if you will, or whatever you want to call the bottom of the base, and you only want to risk 6%. So you're just now going to take it from a mathematical level and just say, look, my average gain is say maybe 10 or 12%, so I don't want to risk much more than 5 or 6%. So you just use math at that point. Now, you could also use a dollar stop. For many years, I used just a dollar stop. I came up with a dollar amount that I wanted to risk. I backed into the trade, and when the stock went down that amount of loss, I cut it out. It could be $500, $1,000, whatever it may be. Of course, you have to take a look at that and see what that, percentage wise, if it's too tight, you may choke off the trade. So these are the type of stops. But what I try to do is I try to back into risk. And I want to try to trade as close to what I call the danger point as possible. This is actually something that Jesse Livermore talked about, trading near the danger point. And that just simply means what I just said before about backing into the stop, a mathematical stop that makes mathematical sense based on your numbers. And also you're trading where when that stock goes through that stop, it's also undercutting some type of technical level that's telling you that there's a problem with the stock. So in this particular instance, this was a stock that I bought after it gapped up, put in this little pullback or a little small little cheat area here. Bought it as it started turning up here, and then I used the low of this little base, if you will, or pivot, if you will, and use that as the stop. So I'm pretty close to that level. Right, I'm not too far away from that level, so that makes not only mathematical sense, but I like the way this stock was acting, and it held this low, and it traded up, reversed, and traded right at the high there. So I deemed that this low was an important low, and I'm trading near that danger point. Now, so you have two things. One, your stop loss and your position size. So again, these are going to correspond with each other. And I'm going to show you that when we talk about position sizing, I'm going to show you how everything's connected. Okay, your stop loss, and your position sizing is all connected, and it's all going to be connected around how much you risk of total equity. We'll get into those calculations later, but those are the two things that are really important here. So you're always backing in to the risk and knowing where your stop is before you ever even get into the trade. So before I even make this trade, I've already figured out this is where my stop is going to be placed, and I already know that level. So when I get into the trade, that decision has already been made. Once it hits that point, I'm out, no questions asked. And you want to back into um, technical stops that make some type of mathematical sense. Here's Medivation, a stock that I traded where, some of you might ask, well, why didn't you buy when it came out of this base? Well, in this particular instance, I just missed it for whatever reason. It had broken out, and then it pulled back pretty orderly here, right back to the top of this base here, and it also pulled back to the 20-day moving average. So as this turned back up, I bought it and made a decision that this was a natural reaction back to the breakout point, and for this to work and be deemed a natural reaction, it should be a new high ground fairly soon and not undercut this low. So I'm trading near the danger point for the low that it just made in the natural reaction. And then, of course, below this base, this you definitely want to hold this level. This is where it broke out from. So to come all the way back, take out the lows of that base, that would be definitely abnormal. So I'm close to the danger point in two places here. And I'm just trading, as it turns up from the natural reaction. So again, this is where you want to take as little risk as possible whenever you're placing a trade. And the thing you got to realize also, as you're entering these trades, and we're talking about stop losses as protection, stop losses are not going to necessarily protect you if you get stopped out a whole bunch of times. We call it death by 1,000 cuts. So just because you're using stop losses doesn't necessarily mean that you're not going to have a big drawdown. There's some other things that you have to manage. You have to be prudent in how aggressive you are when you first start entering the market. And the thing to remember is trading is not an on or off business. This isn't, you don't have to make an all or nothing decision at one time. You're bullish, you're bearish, you're in with everything, you're out. It doesn't have to be that type of decision, and it shouldn't be. So I want to tell you exactly how I enter the market from cash because when the market gets into a correction and I get stopped out of my names, at some point I'm in cash. I'm in 100% cash. So from that point, as stock starts setting up again, now I'm going to redeploy some of that cash and I'm going to get back in the market, right? So how do you go from being in cash to getting into the market and getting fully invested and making these decisions with these stocks that you're setting these stops? Again, a very, very important element of not having big drawdowns, of course, number one is using stop losses to protect yourself from a big loss in any one stock. However, you've got to make sure that you're also using what I call progressive exposure. So progressive exposure just means that you're letting success finance future trades. So you're never entering a lot of trades without or getting a lot of exposure in the market until you've already gotten some traction and seen some success with some smaller exposure. So the general rules are small success leads to bigger success. let winning trades finance your larger risk. So you start off with maybe some smaller risk, and then as you get winning trades, you can increase that risk. Now, the key is that you want to scale up when you're trading well and scale down when you're trading poorly. It works the same in the opposite. When you're doing poorly, you're going to scale back. So I I like to trade a 2 to 1, right? On average, I want to be 2 to 1. We talked about that ratio, a 2R trade at minimum. So the way this works is that, let's just say that you have your first stock that you trade. You go into the market and you take one trade, and that trade is a profit. Okay, and you take that profit at, say, a 2R, right? Your whatever the percentage might be, we're going to call it, you had a $1,000 risk, and you took the profit at 2R profit at $2,000. Okay, so now you now have $2,000 to finance two more $1,000 risk trades. And if you were to lose on both of those trades, you would be back to break even. So now you're using that one win to finance two more trades. All right, this is what I call progressive exposure, allowing profits to finance risk. Now, you can even do this scaling in. A lot of times what I'll do is I'll start with smaller positions, and then I'll start bumping those positions up. And again, it works the same way. So let's just say that your full position size would be 25%. That's your maximum, your largest position that you're gonna take in your portfolio. So I'm going to start at a quarter position, right? The market, I'm not sure yet if things are working. It's been a bear market or a big correction, and I'm just starting to get back into stocks. So I take a 6.25% position, or maybe a 5% position. I risk $500. I take a 2R. I make $1,000 on that, right? I sell it, make $1,000, or maybe I'm even just up $1,000. All right, you could even, finance open risk, open trades. So even if I had a few names that I'm up, that would be enough for me to add some more exposure. So, but let's just say that you took the $1,000. Okay, now that is going to allow you to finance a double sized position that you just traded, because you took 2 to 1. So now you can go from 6.25 to 12.5 and take a larger position. And if you were to lose on that position, you come right back to break even, because you're risking you're risking your profits, right? So now you're risking 1,000, right? You made 1,000, you're risking 1,000. Okay, let's just say you get another winning trade. Now you got two winning trades back to back. Okay, now the same thing can happen all over again. You now can risk 25%. You can bump your position size up even more, and take a larger position. Okay, so now if you were to lose on that trade, you've now risked $2,000, right? So now you have a losing trade. Your P&L is $1,000. Well, that finances another 12.5% position, right? You've actually financed a full position and a half position. And if you were to lose on both of those, you'd be back to break even. Now, a lot of times what happens is, in a good market, you're going to have a winning streak, and you're going to have a bunch of trades that are all doing well at the same time. Maybe you get knocked out of one or two out of four or five or six, but on balance, you're going to be doing well. The key is that you want to use this type of pyramiding strategy, because your goal is to trade. Well, I should say, using this type of method guarantees that you're trading your largest when you're trading your best. And by scaling back when you're trading poorly and decreasing your positions, you're trading your smallest when you're trading your worst. And that is the key to trading large in a bull market and going into cash in a bear market, is to always bend in the direction that you're gaining traction or losing traction. Let me show you again how that works if you were to get a winning streak with 3 profits in a row. So you take a quarter position, you make a profit, you parlay that into a half position, you make a profit, you parlay that into a full position. 3 trades in a row, profits. That now finances 3 full positions and a half position. If you were to lose on all those positions, you would just break even. You see, so this is how you avoid large drawdowns, in particular going from cash into the market. This is how I've gotten big returns but kept the risk down. This is many of the traders that have done really well that I've trained, and people that have worked for me. This is a key technique in and out. Here's the thing. Sometimes you pyramid up, and just as you get large, the market gets hit and you get knocked back down. And then you sell and you scale down. And just as you scale out, market turns back up and stocks turn up. That's the cost of doing business. That's the insurance policy that you're taking. So you will, on occasion, you're going to get whipped around a bit. But when you lock onto a trend and the market takes off, similar to like we just did in 2020, this market took off straight up. And if you've been using this strategy, you would have pyramided yourself into a very fully invested position, or maybe even margin if you're using margin. And this lockout rally would have been your friend. And the same thing when we went into the decline, a 9,000 point decline on the Dow. If you hadn't taken your exposure down and you start doing the opposite, and you're ramping up your trading and trying to get even, you would have bought right into a disastrous situation. And maybe it could have been even worse. It could have been something like the 2000 bear market, where it went on for years, or a 29 situation. So the key is to try to trade at your largest when you're trading your best, and your smallest when you're trading your worst. You're going to use profits to finance your risk. And you're going to start with relatively small pilot buys. That's what I call them, pilot buys. So I take a few test buys. If those work, I move right up from maybe 25%. I might start off with 125% position. If I really like a particular stock, risk is tight, I might have 125% position, or I might have 5% positions. But my exposure is 25%. That's what I usually start off with, 25%. If that works and I start seeing traction, I move to 50%. And maybe that's 2 stocks at 25%, or 5 or 10 stocks at 5 or 10%. It could be a combination, but my exposure, I'm going to keep limited until I see that traction. Now, if that starts working, usually a few trades or a few waves of setups, then I move usually right to 75% or 100% invested, and I very quickly ramp it up. You don't want to spend too much time ramping up, because then you're late. So as soon as you get the evidence things are working, you move up. The key to remember is, if you're not trading well at 25%, if you're not profitable at 25%, there's no intelligent reason to move to 50%. Why would you start increasing your exposure if things aren't working? Unless you want to argue with the market. And if you're not doing well at 50%, there's no reason to move up to 75 or 100. So that's the thing, and certainly not margin. Here's your trading priorities, right? When you're trading, the very first thing that you want to determine is your risk. That's the first thing that you're going to determine. My risk determines everything when I make a trade. That's why I'm looking for that tightness on the right side. I want very low risk entry points, and risk is everything where I'm cutting my loss. So I define my risk. Now, once the stock moves above the buy point, it breaks out, it's now profitable. Okay, now the next thing that I want to do is I want to start thinking about protecting my break-even point. I don't want to do that too quickly, though, right? I don't want to jump the gun, and some people raise that stop up so quickly they choke the trade-off and they don't give it enough room. You stick with that stop for a while until you get a fairly decent gain, and usually until I go through a natural reaction and take out the natural reaction high. Then once I get into new high ground after a natural reaction, you see that tennis ball action we talked about, then I move my stop up. Usually I'll move it up to break even, or at least cut it in half. If it was an 8% stop, I'll make it a 4% stop now. All right. Now, at some point, as the trade progresses, now I need to protect my profit. I'm usually going to sell into strength, but I'm almost always thinking backstop. If the stock's up 20%, I'm not going to let the stock come all the way back down and stop me out at 20% unless I can't help it and it moves so quickly or it gaps against me. So I'm going to come up with a number in my head and say, okay, well, I want to protect 10%. Usually I'm going to protect, if I'm a multiple of my risk or a multiple of my average gain, I'm going to protect my average gain. So let's just say my average gain is 12% and the stock's up 25. All right, so now I'll let that stock maybe come back. Maybe I'll sell half of it, sell part of it at up 25%, and now move my stop up to 12% to make sure that I'm staying above my average gain. Or at 25%, I can actually move the stop to break even, and I will still end up making 12.5% on the overall trade and still maintain the integrity of my average gain. So there's a number of ways you can do this, but the key is to remember your trading priorities. And as the trade progresses, your priority shifts with the trade. Now, of course, if your stops hit, you're out of the stock. So now you don't ever want to let a big gain turn into a loss unless you can't help it. All right. And so this is a perfect example of a stock that breaks out. It runs up very quickly, just in 1, 2, 3, 4, 5 days, it's up 30%. Now, if you're not selling some there, you should definitely be selling some as it goes through a natural reaction and then it fails, and you may feel like, oh my god, I was up 30 and now I'm only up 10. Well, you'll feel a lot worse when you give it all back or you go into the loss column. So you always want to protect, you're protecting your gains. Once you and that is one of the keys that I had to change. One of the things that I was doing wrong in the beginning was I was not locking down my gains. I would very often give back a good portion of my gains, and that would be a big problem because now I'm having these drawdowns. So now I sell into strength a lot, and I'm usually getting out early of the trade. A lot of trades that I trade out of go even higher, but I don't care. I'm just concerned with in between where I bought it and where I'm selling it, and make sure that I'm making a good size profit versus what I risked. So again, this would be very unnatural for a stock to go up 30% and then have a natural reaction, try to turn up, and then come back in. I would definitely have my stop at break even, and that I, I would probably never get that with a 30% profit. I would hardly ever have a stop that I used at break even. I would probably choke it off even more. So if you were to be in that situation, right? You're at that 30% profit, and maybe it's the beginning of a new bull market after a bear market. You probably will be indecisive. You'll probably be wondering, should I hold this for a bigger move? Should I sell it? This is where the real problems happen in trading stocks, is when we're at a profit and can't decide whether we should sell it, whether we should hold it. So psychologically, a psychological win-win is always to sell half. No other percentage works. If you sell 25% or 75%, it psychologically doesn't win. And I'll tell you, it's not a psychological win-win. And I'll tell you why. So if you reduce half of the position and it goes higher, you say to yourself, wow, thank God I held half, right? If it goes lower, you say to yourself, wow, thank God I sold half. See, it doesn't work. With at 75%, you only saying that on one direction more than the other. But equally, when 50%, if it goes higher or lower, you're sort of happy because you can rationalize that. You could tell yourself that you still held half of it. You sold half, but you still have half either direction. So it's a psychological win-win. So my general rule is, if I'm indecisive and I really can't decide and I'm agonizing, I sell half. I sell half. Now, what you can do by selling half, once you're at a profit on a stock, your options open up. You have options once you have a profit, and you want to use them properly. So in the beginning, you're just taking risk. It's all risk, right? You have no profit. You don't have any options. You have one option. Wait for the stock to become a profit or get stopped out. Your stop is your only option at that point. Now, once the stock moves up and you're at a profit, now you have some options, and especially if you're at a multiple of your risk. So let's just assume that this stock here breaks out of this base, it runs up, you let it go through a natural reaction, and you're at a decent profit here, whatever it is, 15, 20%, 30%. So you can now move your stop to break even and free roll the trade. You're risking nothing now. I mean, obviously, if it gaps down and goes through it, you would lose money. But being up so much, you've got a lot of room, and you should probably be fine with a break even stop. So now you're free rolling the trade. You're risk free. The other thing you can do is you could sell half, move your stop to break even, and now you've guaranteed yourself a profit. So let's say the stock, and this works well when you're at a multiple of your average gain. So let's say your average gain is 10%, you have a 20% profit. Okay, if you sell half and you move your stop to break even, you will guarantee yourself a 10% profit, protecting your average gain and and protecting the integrity of your average gain, because you want to keep that average gain at least where it is or improve it over time, right? That's the whole key. So another thing you can do is if you sold half, and this would work if your profit is 2 times your risk. So if you sell half at, say, let's say the stock, your stop is at 8% and the stock is up 15 or 16%, you could sell half and keep your stop. And now, once again, you're free rolling. You're free rolling the stop now. You have financed the risk. With 2 times your risk, selling half covers your risk. So now if the stock comes all the way down and stops you out at that 7 or 8%, you're just breaking even. So you finance your risk. So these are a few ways to use your risk. I'm sorry, to use your profits to finance your risk. So you see how this is sort of a theme. I start off by progressive exposure, using my profits to finance my risk. Now what I'm doing with each individual trade, I'm doing the same thing in managing the position. Not only am I managing my exposure and my initial entry into the market, I'm now managing each position in a very similar way. Always using, always trying to finance your risk, always trying to free roll, always trying to cover yourself, all from risk. Always remember, risk first. Always think risk first. All right, let me show you how this works. So again, guaranteeing a profit, free rolling half, or free rolling break even by financing your stop. So here you go, you break out, right? You break out of this little cheat area, stock runs up, right? Pulls back, gets through the natural reaction high. That's where I'm almost always going to move my stop, at least move it up or move it to the break-even point. Once I have a natural reaction, I can get into a new high. Because now if this stock comes all the way back down, takes out that natural reaction low and comes all the way back down to break-even, that's very abnormal. All right, that's abnormal, and I don't want to let that turn into a loss, especially if this is a good size gain. You don't want to ever let big gains turn into losses. So, and again, if you want to sell part of it, sell half of it, if it's at a multiple of your risk and finance the stop, you could do the same thing, right? All right. So now here's another position management technique, which we call the reduce and add back. So a lot of times I'll trade a cheat area or a low cheat area, and sometimes the move from the cheat area back up to the old highs where it's very likely to build a handle or run into some supply on the left side of the base, and pause it out where it builds another pivot. Very often that move right there is enough profit to justify my stop. So for instance, this move might be where just getting back up to the old highs is maybe 12 or 15%, and my stop is, let's say, 5 or 6%. So again, a move here is a 2-hour trade. So, and again, I'll do this sometimes if it looks to me like there's supply on the left side, and I think that stock's going to, maybe rebuild a base, and it happens at the same time where I've got a good, I have a good R trade. It's going to be, 2 Rs or better. So now let's just assume, I buy the stock here, I set my stop, whatever the number might be. Let's call it 6%. Stock runs up 12 or 13% to the old highs. I sell half. I move the stop. And now again, I'm free rolling half. I've guaranteed myself a profit. If I don't move the stop, I'm guaranteeing myself a break even. And now if the stock rebuilds the base and sets a new pivot, I'm adding back as it moves out of that base. And then very often what I'll do is I'll move the stop up where on that position I would have my stop, but I'll move it up on the entire position. So now what I've done is I put a stop that's protecting me from a big loss on the second half, but I've also turned that stop into a backstop and backstopping my profit on my original position. So very, very simple concept. So let me show you how that works when I traded Ford. So I bought Ford coming out of this little breakout here. And then as it moved up and it got through this natural reaction, I moved my stop up to break even. It ran up and I sold some as it got extended. And then stock builds a new base and then comes out of here. And then I think actually this one, I'm pretty sure I didn't add it back. I'm using this as an example, but I'm trying to remember the Ford trade. I think this one I didn't add back, and I was kind of kicking myself that I didn't add it back because it was such a nice little base here. But I still held some of it and sold at a profit. So that just showing you some real life examples how you can trade. So we call trading around your position, where you can keep a core position, and then reduce it and add it back. Now, a lot of times I'll do this also if I take an overweight position. Sometimes I'll go overweight in a stock, and if it works out very quickly, I'll take the overweight off, get back to a regular size position, and then trade in this manner and use the overweight again to finance the risk. That things would have to be working pretty well, and the markets, everything's working out before I start going really overweight in positions. Again, another one, Rambus. I traded this one. This was a long time ago, but I traded this stock. This came out of this IPO base, and in just 5 days ran up almost 60 some odd percent. So I had sold right into that. It was just such a nice gain so quickly, and then it rebased, and then I bought it back out of a new base. And again, you can see, you could have done this in a number of ways. This would have worked perfectly if you sold part of it and then added it back, moved your stop, free rolled. This is a perfect trade for that type of position management. All right, let's talk about the add and reduce, which I kind of talked to you about that a little bit in the past example. But this is how you average up without adding additional risk. You add shares, or you add more exposure in a stock without adding additional risk. Very simply, you start off. And again, I'm going to use the example from a cheat area where you're buying 1,000 shares at 16.50. You set a dollar stop. All right. In this example, we're setting a dollar stop. So if you have 1,000 shares with a dollar stop, you're risking $1,000, right? Okay. So now the stock moves up. You haven't sold any. All right. You're still holding your original position. So now it sets up, and the base improves, right? It goes from a cheat area to building a nice big cup with handle, VCP. It starts breaking out of that area. So now you add 1,000 shares. And like I told you before, we're moving our stop up now, and we're using a stop here, a $1.50 stop at 17 on 2,000 shares, right? And we're buying it at 18.50. So now what we've done is we've backstopped, again, we've backstopped the original position, and we put a stop loss on the rest of it. So now what we have is we have a $1,000 risk once again on 2,000 shares. So now we've doubled our exposure, but we haven't doubled our risk. We kept the same risk. There's a million ways that you can do these position management techniques. All right, I'm just showing you a few. I'm showing you some concepts and some techniques that I use on a regular basis. These are pretty much the top three that I use 90% of the time. This is how I'm trading and I'm pyramiding. I'm always asked, how do you pyramid into stocks? I'm not just buying more of a stock just because it's up. It needs to always set up in a base and have those same parameters that I'm looking for on the original trade if I'm going to buy more shares. But I'm always looking at the math. I'm always looking at the math behind it, and always thinking risk first and how I can get myself a free roll, right? I want a free roll to trade. I want to be risk free. As soon as I can get myself into a risk free situation, that's what I'm trying to do. Always trying to angle myself into a risk free situation. So let me show you how this works. Again, I traded this Red Robin. I remember this one really well. Had a big gap, came back, put a little cheat area. It was a little questionable, but I did pyramid up on it. It came through there, and then it set up here, and then I bought more here, and then I moved my stop. You see, I moved my stop here on the whole position, and then when it rolled over, it took me out, and it took me out of the original position here at a backstop, and it took me out of the second buy at a stop loss. So I lost really nothing on the trade. And then, of course, the thing imploded. So my stop loss saved me there. So now, with what I just went over, I want to ask you a question and show you something here. And again, show you this concept. Extend on this concept, if you will. And with what you've learned and what you've heard me talk about, looking at this trade here, all right, you bought here, coming out of this base right here, and you set yourself a 6% stop, right? And you sold it here at a 41% profit. Obviously, you can see what happened to the stock in between your buy and your sell. It broke out, never came back to the break even or to the stop. And then you got a nice gap, whether it was on earnings, whatever it was, and you sold into that gap and you made yourself 41% on the trade. The question is this a good trade? Did you make good risk reward decisions in this trade? Now, while you're thinking about that, remember a few things. One, you want to always think in terms of risk versus reward. You want to always put risk first and think in terms of risk versus reward. Let me show you how this plays out here. And sometimes this is hard to understand uh, on how the thinking needs to be when you're making a trade. You might have an idea of where you're a seller. So, for instance, let me just show you the math behind this. So this stock goes up 29%, right? We'll call it 30%. It goes up 30% and you don't sell any. You don't sell any, right? In our example, you waited and you went through this pullback, you got yourself a gap and you took 41% a profit. Well, if you take a look at the math, the stock pulled back 16% and then you sold the stock when it was up 8% from where you already were. So you took a 16% risk for an additional 8% gain. Now, you didn't know that this was going to go up to 41%. However, if you had known that you were going to be a seller, if I told you, well, let me ask you a question. You're down, you're here, and if this went up an additional, 10% or so, and you were up 41%, would you sell the stock? And you say, yeah. Well, if that's the case, you've got to calculate that profit of where you're a seller and base your risk on how much you're going to let this come back and give up this gain based on that reward. This is why you have to reevaluate your position every day. Every day you're reevaluating. If for those that are on my private access service, you know that I update the stops every day. Some people have asked, why do you update them every day? Because I'm reevaluating every single day. Every single day I'm looking at the chart and I'm looking at the risk versus the potential reward. And I'm asking myself, does this justify me taking this type of risk, or do I need to change it? Do I need to tighten my stop? So in this particular instance, if I know I'm a seller up here at 23, 20 or $24 and I'm already at 22, all right, that's 1.5, 2-point gain. I'm not going to let the stock come all the way back down to $18 or $17 and let it drop 4 or 5 points for a 2-point gain. What you've just done is you've flipped the risk reward ratio. You've inverted your expectancy. All right. So here's just an illustration of it. Of going from 3 to 1, right, to 1 to 2. You've now by letting that stock come all the way back down and then selling it when it's only X amount above where you already had a profit, you've laid 2 to 1, right? You're not getting 2 to 1. You were getting 3 to 1 here. Now you're laying. Remember, never lay odds. Remember when I said that? Never lay odds. Well, that includes on a daily basis. So the key is you want to evaluate your position every day and ask yourself a few questions. One, would I buy the stock right now? Would I buy this right now? So if this stock here is up here, it's extended, and you say to yourself, would I buy it right here? No, it's extended from the base. Obviously, we wouldn't buy it there. Okay, so then you have to justify, why am I holding it? Why am I holding this stock if it's not a buy? Okay, well, maybe the stock hasn't made a big enough move. It still looks great. Okay, that's wonderful. But where am I a seller? Where am I a seller on 2 counts? Where am I a seller at a profit? And where am I a seller when it comes back in and gives up my profit? I have to be thinking that all the time. Otherwise, we're going to be caught off guard. Stock's going to come in, not know what to do. Oh my God, it's down 4 points, now 5 points. The next day, all of a sudden, you've given back more than half of your gain. And now you're kicking yourself going, oh, I should have sold up there. You're in the should have, would have, could have. It's a disaster. You got to be thinking in terms of risk versus reward at all times. If you know where you're a seller, then you're going to be able to respond not only if the stock comes in and you can backstop and get yourself out based on your risk reward and protecting your average gain and everything we talked about, but you're also going to know where you should set that stop based on any future reward of where you may be a seller. So always thinking in terms of risk versus reward. Here's another example. So this is Body Central. Now, I bought this. Um, I bought this one right here coming out. I think we talked about this we talked about this in Primary Base. This is that stock that I saw in the mall with my wife around Christmas time. And then the stock happened, I checked and the stock happened to be set up perfectly. And I bought it, came out, and then it just rocketed off, was up 40% in a very short period of time. I sold right into that. Now, had I not, okay, again, this stock went up to about close to 80%, 78%. Um, had I known, had I said to myself, if this stock goes up, if I'm up 80%, I'm going to sell this stock, right? You could think in those terms, 80%. Well, it's not really 80%. You're already up 40. So that's another 27% from the 40%, right? You add 20, you compound 27% onto the 40, you get 78%. So to allow this to come all the way back down near the breakout point is not a great risk reward decision, right? You're risking 27% or even more to the breakout point for a 27% gain. It's 1-to-1. You're not getting odds on your money again. There's no odds. So again, knowing where I'm a seller lets me know how much I should risk. At the very least, I would probably, in this type of situation, if I wanted to play it for a bigger move, up 40% in such a short period of time, I'd probably sell, half of it, guarantee myself a 20% profit, move my stop to break even. Now it makes a little more sense of me letting the stock come all the way back down. All right, this next thing I want to show you, don't take this literally as you should compound or you should not compound. This has been something that I put in my book, and it's been misunderstood many times that people think I'm saying compounding's no good, or not compounding is what you should do, or compounding is not the way. No, that's not what the example is here. The example is to show two things. One, that the more, they're just saying, the more you torture numbers, if you torture numbers long enough, they'll tell you anything you want to hear. Okay. So that's one of the points to make here, is that numbers can be manipulated. So you have to understand them and understand them with clarity on what they mean. The other thing is to show you that losses work geometrically against you. And if you have large losses, then your compounding goes out the window. All right. Even if your gains are similar. And in this particular example, you have 24 trades and they alternate between a 50% profit and a 40% loss. If you compounded that, all right, if you compounded that gain, you would lose 71% of your money, almost 72% of your money. If you did not compound it, you would actually make $120,000. You would be up 120%. So you might say, well, then why should I compound? I should not compound. No, absolutely not. If you have an edge, all right, if it's not under this circumstance where your losses are as big, if your losses are going to be as big as your gains, yes, then compounding is not going to work. Compounding is going to get you in a lot of trouble. All right. So, but your losses need to be a fraction of your gains, and then you'll have even a much bigger gain by compounding. So the real point here is that numbers can tell you anything, all right, if you don't understand them, and losses work geometrically against you. So you are not going to grow your wealth unless you compound. You have to compound. In order to compound, you've got to have a mathematical edge. All right, so we're going to get more into risk, more talking about stops, position sizing. We're going to come back with position sizing and some other fun things. But we're going to take a break here. Okay, we'll take another break. Let you think about all this. I think your head's a little swelled up right now. And then we'll come back in a little bit. Okay, take a break. See you in a bit.
All right, guys, that is the end of risk management part two. And just as Mark said, I can only imagine what each of your faces look like because I know what it is. We're going to take a 5 minute break, full 5 minutes here. Uh, get your heads a little, situated. Go do your push ups, get that blood pumping, get something to drink, get something to eat, go to the bathroom. The next section will be risk management part three. Starting on page 407, we'll be back in 5 minutes.